Last week, one of Wall Street's biggest private lending firms did something that should terrify every single person with a savings account or a retirement plan. They permanently shut the door on investors trying to withdraw their own money. Not temporarily paused, not delayed for processing, not restricted for a quarter. Permanently closed. Your money is inside that building, and you are not getting it back. The financial world erupted with the story Blue Owl Capital, a firm managing over $300 billion, permanently closes its $1.6 billion lending fund after withdrawal requests surged by 200%. The firm then sold $1.4 billion in assets, not to repay investors, but to cover the fund's own debts. And Blue Owl was not alone. At Ares Management, investors in a $10.7 billion fund submitted $1.2 billion in withdrawal requests. They wanted 11.6% of their money back. At Apollo, the same. At BlackRock, the same. Across the entire industry, the message was identical. Your money is here, but you cannot have it. Ars activated a clause buried deep in their fund documents and capped redemptions at 5%. $1.2 billion requested. $524 million returned. For every dollar investors asked for, they received less than 44 cents. The rest is trapped inside a fund they no longer want to be in. Think about what happened here. They took the assets investors owned, sold them off, used the proceeds to pay the fund's creditors, and the actual investors who put the money in, they got nothing back. That is not a market correction. That is a heist hiding behind legal fine print. And what I am about to show you is just how massive this hidden system really is. $3 trillion. That is the size of the private credit industry today. One of the largest pools of unregulated lending capital in human history, built entirely in the shadows, with almost zero transparency, almost zero oversight. And right now, it is cracking wide open from the inside. So how did we get here? How did Wall Street build a $3 trillion lending empire that operates completely outside the banking system, convince millions of ordinary people to pour their savings into it, and then write a clause in the contract that lets them lock the exits whenever they want? The answer is a machine, and it was built deliberately. After the 2008 financial crisis, regulators cracked down on banks. So Wall Street invented a workaround: private credit funds. Unregulated lenders making the same risky loans banks were now forbidden from making. By 2015, the industry reached $500 billion. By 2020, $1.5 trillion. By 2026, $3 trillion. A 60-fold explosion in barely a decade. Here is how the machine works. Private credit firms borrow money from banks, your banks, the ones holding your checking account and savings, and then lend it to companies traditional banks will not touch. Riskier borrowers, higher interest rates, bigger fees. The fund managers get rich. The banks collect a cut. And you are silently backstopping the entire system without knowing it. $300 billion. That is how much American banks have funneled in direct loans to private credit funds. That is not some abstract Wall Street number. That is money connected directly to your deposits, your savings, your bank's balance sheet. If these loans go bad, and they are going bad, the losses do not stay in the shadows. They come straight home, to your bank, to your money. And the entire time, the marketing pitch to investors was brilliantly simple. Steady returns, low volatility, better than bonds, safer than stocks. Private credit was sold as the new safe haven. A reliable, predictable income stream without any of the drama. That was the glossy brochure. That was the confident handshake. But it was never ever true. Jeffrey Gundlach, the legendary investor they call the Bond King, said it plainly. Private credit fund of funds in 2026 closely mirrors CDO-squared in early 2007. CDO-squared. That was the exact financial instrument that detonated the 2008 global crisis. The same DNA, a different mask. And just like 2007, the people designing these products knew exactly what they were building. They knew the risks. They knew the exits were narrow. They knew the fine print gave them the power to lock the gate, and they sold it anyway, because the fees were too lucrative to stop. But here's the part that should truly make you furious. Blue Owl Capital, the firm that permanently locked its investors out, draws 40% of its $300 billion in assets from individual investors. Not Wall Street insiders, not sovereign wealth funds. Regular people, families, retirees, people who trusted their financial advisors when they said this was a smart, conservative place for their savings. And it gets worse. The United States government recently gave the regulatory green light for private credit managers to sell directly into the $13 trillion defined contribution market. That is your 401k, your company pension plan, the money you have been saving for 30 years so you can retire. And now it can flow straight into these same locked rooms. The private credit default rate has already climbed to 5.8%, and analysts at UBS warn that under stress, it could spike to 13%, more than triple the rate for traditional high-yield bonds. These are not safe haven returns. These are junk bond risks wearing a three-piece suit. So let me spell this out. They built a $3 trillion shadow banking system, loaded it with risky loans to companies that real banks refuse to touch, wrapped it in a glossy brochure that said safe income, sold it to retirees, pension funds, and your 401k. And now that defaults are spiking and investors want out, they lock the door. From the outside. Even Jamie Dimon, the CEO of JP Morgan Chase, the most powerful banker on earth, saw this coming and sounded the alarm. His exact words, "When you see one cockroach, there are probably more." And so everyone should be forewarned on this one. When the man who runs the largest bank in the world tells you to be afraid, you should already be gone. Now pay attention to this last part. Because this is not just another story about Wall Street greed and ordinary people getting burned. This is a story about a fundamental truth that most people learn far too late. A truth about who really controls your money. About what it actually means to own something, and what happens the moment you hand that control to someone else. $265 billion in market value has been erased from private credit firms since the start of 2026. Blue Owl stock has collapsed 60%. Ares, Apollo, Blackstone, KKR, every major player has been dragged into the fire, and the contagion is still spreading. Here is the truth the financial industry will never tell you. This was always possible. The fine print always allowed it. Every single prospectus, every offering document, every contract you ever signed, they all contained a clause that lets the manager lock the gate at will. The question was never if they would use it. It was always when. And this is not just an American problem. Private credit has exploded across the globe. The United States, the United Kingdom, France, Germany, Australia, Japan. $3 trillion of shadow lending spread across every major economy, with no coordinated international oversight. When this unravels, it unravels everywhere. Sovereignty means one thing above all else: custody. If you do not hold it, you do not own it. If someone else controls when you can access your own wealth, you are not an investor. You are a guest in someone else's house. And when things get uncomfortable, guests get shown the door. Do not be the guest. Be the one who holds the keys. And never let anyone lock a door between you and what is yours.